next up, we've got Stephen Mitchell from Resicom and Oak, which is now both together as part of a wider business, which I'm sure he will touch on or talk about, or would be happy to talk about if it's not in part of his presentation. And he's going to be going around private loans, low doc loans and stuff that's outside and doesn't fit the normal banking landscape, and where that can fit into, part of this COVID response and trying to recover, thrive and survive in this environment. So I'll now hand it over to you. Thanks, Stephen.
Thanks very much, Shane. Thank you everyone for joining us today. So just to introduce myself, Stephen Mitchell of Oak Capital. So that we did hit market yesterday with a little bit of announcement that we've been working on for a while, which was essentially taking out the full ownership and control of Oak Capital as a group. I have another business which has been around for 15 years in Resicom, and that entity now will ultimately become a subsidiary of the Oak companies moving forward. So there was some information on the Advisor, which is the mortgage industry magazine as such, and that went out yesterday. So we're very excited by that, and ultimately we're forming the businesses from 2021 really to hit as one brand. We've decided, given the hangover of COVID that's still affecting all of Victoria, we can't exactly go out and have a big party and celebrate it with all of our clients and colleagues. So we're going to sit on that sort of announcement and rebranding as such from next year. But together they are effectively one, but we'll leave some partying for next year when Dan Andrews lets us all out. So let's just to touch on, I guess, a bit about Oak and a bit about Resicom, so people know where we're coming from. Oak Capital is essentially a funds manager and a mortgage fund provider. So we have two mortgage funds. We're a private lender ultimately, if you look at our history. So in saying that, we look at assets, real estate assets anywhere across Australia to lend on, and we lend generally 65% LVRs on property or below. We do first mortgage lending and we do some second mortgage lending as well. And one of the keys with being that type of lender is we can apply common sense lending to everything that we do. We have two funds, so we deal with retail investors from an investor perspective, and we deal with wholesale investors as well. We have offices in Melbourne, in Collins Street, and also we have an office in Queensland, and the fund's been operating since 2013, so we have a bit of history there. Generally, from an investor perspective, they return 6, 7, up to sort of 10% per annum on their money, and they get to choose their mortgage investments that they like to invest in. So we don't run a pool of money. Every loan that we lend is actually matched with an investor or a group of investors. So from an investor perspective, they know exactly what the asset is that they're secured by. From a lending point of view, generally 12-month loans. So we are a relatively short-term, get in, get out, go over and see Andrew at Macquarie once you've solved your problems. We're not there to hold you for 30 years. We do look nationally and we look at all asset classes, providing it is real estate. So we'll do resi, industrial, commercial, any vacant land. We'll consider everything and then lend proportionately against that. From a scenario point of view, so people have a bit of an idea what that looks like. We might have a client that is going to end up at Dyanco. They've got a wind-up order and they need to pay the taxman $500,000 on, call it Monday. But they've got an unencumbered house because they've done very well at not paying their tax and paying off their mortgage. So we will come in, lend them $500,000 in 3 days. They clear out the tax man, and then they can spend the next 6-12 months sorting out their financials and everything else they need to in order to jump back to the next tier of lending. So they'd pay obviously a price well above the banks to get that sort of transaction done, but it might only be in the high single digits, but it allows them to get out of that impending problem because they have equity. So if they've got equity, then there's generally an option. It's going to come at a price point, but ultimately doing that is far better than going necessarily through a wind-up. It could also have a developer that has 5 units at lockup. He's overspent. The bank's not willing to put any more money in, and they need 300 or 400 grand to finish those sites off. So we were looking at coming in on a second mortgage position, fund that extra 300 or 400 grand. They finish their units, then again, they refinance and away they go. So everything we do should come and go relatively quickly. We do have some cheaper products where they can sit a bit longer, but generally it's a 12-month type transaction. From a Resicom point of view, similar type of market. So we've always been second tier. We've been around 15 years and we're known as a mortgage manager. So ultimately, we don't control the capital. We have other funding lines that we access and we essentially rebrand their money and then sell it out to market through the mortgage broker space. So brokers come to us, again, when they can't necessarily place that deal or they've gone to a bank, found out the client has a couple of defaults and now they're a bit stuck. So they come to us, say, where do I go? We then place that loan with a second tier. It could be a Latrobe Financial, a RedZ or a Pepper, and get that deal placed for them, therefore providing the solution to the client. And from a broker perspective, looking at Resicom and now Oak, I guess the sell is, yes, they can potentially go direct to some of our funders in the mortgage management space, but they need to know all the details about how to do those deals. And a lot of brokers in the market deal in bank will, they write 90% of the time, they're writing bank home loans. So when they get a deal that doesn't quite fit, we're there to help them. And we've got the time and energy to hold their hand to get the deal done. So they'll apply to us and say, what do I do? And we'll say, okay, the best option for the client is product C, but we're going to need this. And then we get that done, get the deal through, and then they can hopefully move that client out 12, 24, 36 months later, back to a cheaper product via a bank. So everything we do, as you can probably tell now, is not bank world. So no one's to call us asking for the 3% interest rate. That's not our world. We're all about providing a solution to the client, okay, and doing that based on their criteria and the speed that they need us to meet that at.
So, Stephen, we've got a question that's just popped in.
Got a deal.
Do you look at the agri land space?
Oh, good deal. So generally, we are, resi commercial, we do small land, we do some DA land. Large agricultural land is very difficult for us to fund. Having said that, if they've got, a 1,000 acre site with a lot of equity and they only need 200 grand to pay out a creditor, we might get involved. But if we're funding $5 million on a farm, we're not going to be able to raise it. So it does come down to the ability to raise the amount of capital. So we do get some where it's a smaller dollar size loan and they just need it and the asset is a rural type asset. We can absolutely look at that. And one of the big benefits we have in our fund, we have the ability with one of our funding lines that we don't need to get an external valuation done. We have an internal team. And therefore, if you were to go get an agri loan done, even if they only needed a couple of $100 grand, the valuation itself could be quite cost prohibitive. It may be, $5,000, $10,000. If we can get comfortable about that number internally with our property specialists, there is no upfront costs. We can tell them what we think it's worth. If the numbers work, we'll do the deal. Exit strategy changes the other thing. If they say, look, it is an agri deal, but they only need 300, 400 grand, but here's their exit in a month, then again, it helps sell the deal. We've got to know a fair bit more. As a rule, we don't go buying rural type transactions, but we are always open to look at anything. Thank you very much.
Fantastic.
So just to finalise on, I guess, the merge. So from a combined point of view, we have approximately 700 million of assets under management of all the mortgages we manage. We have a target of $1 billion by 2022. And yeah, the goal is to be that sort of one-stop shop for everything second tier. So to touch on, I guess, market, what we've seen, obviously the hardship claims that have been going on in the market have been enormous. The numbers from the banks are approximately 270 billion of loans that went on to hardship and moratoriums and not paying. Obviously that's going to have a large effect moving into 2021, and we're big believers that 2021 is when everything's going to start to really wash through. At the moment, people don't need to necessarily pay their mortgage, or things are starting to change now that end of September's come and gone. Even the second tier lenders, we get reports of some that are saying 8% of their book, 23% of their book from another has been on hardship claims. These are enormous numbers that have to have an effect. This interest never went away. It's just been tacked onto the loan and needs to be caught up at some point. One of the statements from a chief risk officer we know is that they're saying, of those claims, generally a quarter or a third, they think can pay, they're just not paying. Another third will get there, but there'll be some struggles. And another third will be a major problem. So we do expect there's going to be some mortgage defaults numbers that are going to start going up through 2021. And those loans will be managed slowly out of these lenders. but it's going to be very, very interesting lending landscape in 21. And we just haven't seen any of that yet. Landlords don't need to be paid. ATO isn't getting paid. Creditors in general aren't getting paid. And look, we've seen that on our loan side. We went quite quiet from loan inquiries for sort of, immediately really from April onward. It started to bubble a bit when we saw signs of life, but then we got locked down again. So everything sort of went pretty slow. And normally we see that distressed market. But if people aren't getting told they have to pay the ATO and they don't have to pay their mortgage because they can just get it put on hold, then they don't need to really come see us. And no one's generally acquiring businesses, buying extra assets. Everything's just on pause. So we're going to see a lot of that come through in 2021. Look, the lending opportunities that we've seen, for the second tier market, again, are starting to bubble. Our inquiry levels doubled in the last 2 weeks. I think there's certain businesses now saying, you know what, we've just got to start doing stuff. They cannot keep waiting. And the realization that you're ultimately tacking on to the end of whatever your debt is starting to sink in. So people are starting to deal with that. The other catch for us as a lender and for clients and accountants out there, we're seeing a lot of startup private lenders. So there's a lot of chase to the bottom on yield lenders coming out. We've got bankers that might leave their job and they got a high net worth client who's sitting on $10 million not getting a yield. So they become a lender. The risk with that, of course, they're lending high LVRs at low rates. No one's following the old rate for risk model. And we think that, again, that's going to be a problem next year. We believe there will be a cooling in the market in some shape or form, and they may get caught. So we are a bit concerned for some investors that aren't lending through a sophisticated structure and are just seeing the return and going with it. There's a lot more to lending than just getting it out the door. You've got to be able to get it back, which is the other big key. So we've been quite cautious ever since February. We pulled back on our second mortgage lending, and we're only now starting to open up a little bit there. And initially we saw also the second tier lenders drop dramatically out of that market, especially in development space as well, which has left a vacuum for a lot of these loans to get filled by potentially unsophisticated lenders, which is, is going to play out next year when we see that occur. Next year, we also feel that the banks obviously will be extremely tight. As Andrew pointed on, credit will go through a bit of a crunch, I think. We've seen that already with the government funding that they've given to banks and other lenders to lend to business borrowers. In discussions with many prime mortgage brokers we know, not many have ever seen a loan go through. So we're not sure who's actually getting this money. But the banks have strictly had, I think the offer got made by the government, and then the bankers got a call saying, beware, if you start lending irresponsibly, we're going to come after you. So you've got this money to lend, but be very, very careful. The problem is the people that need the money can't show they can afford the loan right now. So it's kind of a double-edged sword. So, there's a lot of these ideas that sound good and that they look good on the ads and on TV, but in reality, if you're a small punter businessman, you're struggling to get money. You go to your bank and say, look, my revenue's dropped, but I need one of those business loans. They go, well, you can't responsibly lend to you. So we're going to see a lot of that come through. And if the clients don't have equity in assets, it's going to be a problem. And I think it's going to be, definitely from an insolvency point of view, there's going to be a lot happening. It's just whether or not there's any assets there to get from. In regard to property, from what we've seen, resi, remarkably good, has been remarkably good, even in Victoria. Having said that, you can't repossess a property if you try. So, we haven't seen any of that side of it. There hasn't been that forced side of selling. People are only moving or buying if they are structured to do so. So 2021 will have that play out. Commercial, though, definitely seen problems. We've had an asset outside of Sydney that was 11 million early 2019 and sold for 7. So that is a drop. On the phone call just prior to a large valuation firm I know, they're talking 50% reductions on retail assets already. So these assets, especially CBD, obviously, CBD assets and that are getting quite concerning, and that will then flow over to their ability to access capital. So I don't have a crystal ball as to how it's going to play out. I just don't necessarily believe in the beautiful picture that's going to all occur next year and everyone's going to get back to it. There's going to be a hangover from this. And that means that clients need to keep their eyes open to what the options are. If they cannot get through, then they need to look at certain options. If they can get through, but they need some funding, they need to know what's out there. And it isn't just banks. The banks will tighten up dramatically. The second tier lenders will absorb the old bank deals that the banks wanted. But therefore, there's going to be that gap of what falls out from the second tiers. And that's where groups like ourselves will be there to catch as much as we can. But the deal has to make sense. And the clients need to know that if they are coming in for a short period, they need to have their exit strategy well and truly tied up. We don't provide solutions for them to be there for the next 5-10 years. And generally that they won't last if they have to pay those higher rates. You know, businesses need to have a plan to get back. So it's really important for accountants and solicitors and any sort of advisors to know there are other options, but they need to make sense for that client. And for some clients, they are just better off saying, you know what, it doesn't work now, and to get out, rather than go through the model of just equity stripping ultimately by paying every single man and his dog another fee to get to the same position. So people are going to need to have long, hard looks, I think, at themselves. And it sounds very difficult, but I think we're going in for a difficult market. I guess in sort of closing where we can assist, I touched on our products, but in summary, you know, first mortgages from sort of 7.5%. I think a lot of people have this idea that private lending is scary. Second tier lenders are scary and the pricing is huge. Definitely a lot of accountants have that view. At 7.5% for a deal you can get within a week, it's not overly scary, right? It was what the market was paying only a matter of years ago for a home loan. The key is for us, there's no upfront fees. The deals are real. You know, be mindful of lenders offering huge LVRs, really low rates, but a $20,000 upfront fee. There's a reason they're charging $20,000 up front, because they're never going to fund the deal. So you've got to be dealing with someone who's reputable. We only issue offers that we want to actually fund and settle. We do second mortgages as well. They're obviously at a price point above. We'll do bridging loans. We can capitalize interest. So clients that are affected, if they've got a hospitality restaurant, we've seen one just now in Hawthorn, they are, you know, they're taking the gamble ultimately that the restrictions are going to release and they can get back to their restaurant running, but they want to borrow 6 months worth of interest on their loan. They have to leave the bank because the banks have given them the tap on the shoulder to move, and this is starting to happen now. We've seen it. So we'll fund them in. They'll borrow 6 months worth of interest. You know, there is a bit of crossing their fingers that in 6 months, trading's okay, they get their numbers up and they move back out. But it's either that or the bank sells them or they have to sell now. So it's a clear deal that makes sense for us from an asset position, and also for them. It's a good solution for them to get in and out. Incomplete build sites, as I've said before, residual stock. We're going to have developers holding a lot of assets they finished. Now, if they're not fully leased, if the developer doesn't have financial data strong enough, they might struggle to get those assets held at the bank whilst they try and orderly sell down, especially in a market that may have a slowdown in property. So we can consider lending on the whole group of assets if they've got 10 or 20 units, obviously at the right LVR, and then they can sell down, piecemeal that asset and pay down the loan. So we can put a structure in play that works for them so they can sell them off one by one without getting stung. Non-resident loans, you know, we look at all those sorts of things. Ultimately, it comes down to the asset and then everything else from there. So look, we're here to assist, and we're here to help rehabilitate some clients and also just provide opportunities to settle a purchase that they got stuck with and need money in 4 days. The key is the equity and the exit, and tell us openly and honestly the whole story, and then we can come back to them with the best product that we can provide. But look, I wish everyone in business good luck over the next 12 months. It's going to be an interesting ride, but I think knowing each other and knowing the right places to go, we can all help steer our clients to a better outcome.
Fantastic. Thank you very much for that, Stephen. Very informative. Now, there's a couple of questions in the Q&A box, but I might get you, if you want to perhaps answer them online, typing in. We'll move.
Sure.
I think you've covered off on a few of them in your closing anyway, but you want to do that. And we'll move on to Tony Eldred.